And I'd like to take this time now to bring in our next speaker. Her name is Rehypothecation. Ria, if you are there with us, go ahead and turn your video on. Happy to welcome you to your very first Benzinga Bootcamp.
Hey, Luke. Great to see you.
Awesome. I don't know how much you've caught of the day thus far, but awesome to have you here and keep the conversation running.
Yeah, great to be here. Excited for this chat with Raoul.
Awesome. But before we get started with Raoul in just a few minutes here, I'd love to hear just a little bit of your background, how you got started with crypto, and where your experience comes from, how you're looking at the world.
Sure. So I started my career at Credit Suisse as an equity research analyst on the fintech and payments team.
Okay.
I spent 3 years there, and that's actually where I got my initial exposure to Bitcoin and crypto markets. I think it was in early 2017 when some of our clients started asking us about Bitcoin and blockchain technology. And then when Square rolled out Bitcoin buying and selling in, I think it was in the fall of 2017, my team did a pretty big report on it, and we got great response from our clients back then. So we held a bunch of events with different crypto companies, one of which was Circle. So I stayed in touch with Circle and realized that I wanted to kind of dive into the space full time. So I interviewed with them and helped build out the Circle research platform there, where I produced thought leadership and content on the broader digital asset ecosystem for clients of the OTC desk and the exchange, as well as the industry. And then I joined Fidelity Digital Assets almost a year ago to focus on institutional clients. So here I produce research and thought leadership for our institutional clients of Fidelity Digital Assets.
Awesome. And I mean, it's great to see some of these big institutional names getting excited by the space. We had somebody on from Bloomberg earlier, obviously a mammoth, now Fidelity. I mean, these are, some of the biggest hitters in the world, institutional wise. And I think it sort of serves as a little bit of a litmus test for the legitimacy of this.
Yeah, definitely. I think, seeing how far we've come just in the past 2 years in terms of institutional interest and adoption, and then I think it's certainly been accelerated by the kind of macro environment that we find ourselves in today. So, I think that's pulled forward a lot of people's investment agendas as it relates to Bitcoin and digital assets.
Awesome. And I should have done this at the beginning. I keep forgetting to do this at the beginning, but just to give you an idea as the audience that we have here today, we've got some people who've been in the crypto digital asset world for a long time, or I guess a relatively long time. Nobody's been in it for too long. But a lot of our audience today are people who are more from like the traditional equity side of things, right? The people like myself who've been involved in the stock market for quite a while, but not super involved in the crypto world and wanting to learn more. And you mentioned thought leadership a couple times. Any resources that you can recommend for people looking to get a sense, get started, further their educational process beyond just today?
Yeah, that's a great question. All of our research is available on our website, fidelitydigitalassets.com. So, little self-plug over there. We're also going to be talking to Raoul, who is the CEO and co-founder of Real Vision. And they just rolled out Real Vision Crypto, which I think is another really great resource. I think it'll be like similar to their Real Vision platform, but focused solely on Bitcoin and digital assets, and feature a bunch of interviews and conversations with thought leaders in the space. I'll also give a shout out to a few other research firms and data providers in the space. Delphi Digital, all the guys there produce incredible research. They have great coverage of pretty much everything exciting happening in crypto markets today. Masari is another great firm focused on producing really insightful institutional grade research. And then, I think a couple data providers that do a really great job of sifting noise from signal include Coinmetrics and Digital Assets Data. They do a great job as well.
Awesome. All righty. And I see that our producer, Kelsey, has been doing an awesome job today, brought Raoul onto the stream. Raoul, welcome to your very first Benzinga Bootcamp. It's awesome to have somebody from a fellow financial content business here. And with, I'll stop blabbering. The people have seen enough of my intros and outros already so far today. So I'll hop off the stream and let you guys take it from here.
Great. Good to be here.
Thank you so much, Luke. Raoul, I'm so excited to be joined by you today. I'll give you a quick intro. So Raoul is founder and CEO of Real Vision Group and global macro investor. It's been really exciting to see and hear your thoughts and analysis on Bitcoin and crypto markets, especially because of your deep knowledge across asset classes. And I just mentioned this, but you rolled out Real Vision Crypto recently. So, I think which will focus solely on crypto markets. So very excited about that.
Yeah, that's just, it's currently just a soft launch for members, and we'll globally launch it with some very big strategic partners. So it's going to be a huge splash in the space as it comes out. But yeah, we're trying to define the space for everybody.
That's awesome. Yeah, I think it adds significant legitimacy to the space and will be a great resource for people looking to learn about crypto. So before we get into it, could you start off and tell us a little bit about your background and Real Vision and GMI, and as well as what piqued your interest in Bitcoin and crypto markets?
Yeah, so my background is 30 years of financial markets. I've been kind of at the epicenter of the entire system. I worked for a couple of investment banks and then joined Goldman Sachs in the late 90s, where I started and ran the hedge fund sales business in equities and equity derivatives. Hedge funds has been basically the community I've been in since I started in the industry from very early days. I then went on to start and run the global macro hedge fund for GLG Partners, who at the time was the largest hedge fund firm in Europe. They ended up being essentially buying out Man Group, and so become this huge giant of the whole industry. I then opted out of the rat race and moved to Spain and decided that I didn't want to manage money for anybody else any longer. And I started writing Global Macro Investor because I love markets, and I had more experience, particularly for as a hedge fund guy, than anybody else writing research. So I knew I had a place for that. So I started writing, and the world's biggest hedge funds, family offices, sovereign wealth funds, stuff like that, banks became my subscribers. But over time, I realized that, particularly after the financial crisis in 2008 and then the European banking crisis in 2012, that I knew everything that was going on, but most people didn't. And that really sat uncomfortably with me, is why didn't people know? And I realized the media had let them down. They just didn't want to give people the depth of understanding that the people within the financial system had. So I wanted to change that. It was around that period of time, having just almost lost the banks when I was living in Spain, that I got tuned into Bitcoin, because some of my global macro investor clients were some of the very, very early Bitcoin guys.
So and around what year? Sorry.
This was around 2011.
Okay, wow.
2011, 2012. I think I first bought it in 2012. Mm-hmm. So very early days. And I had an inkling that this, and everybody goes through the same Bitcoin journey, is you kind of get to grips with something. Then you think you know what it is. Then you realize you know nothing. And then you go down the rabbit hole and realize you'll never know everything, but you build something. So I've gone down all of that. So when I first saw it, I realized that this was a solution to many of the problems. I was actually looking at creating the world's safest bank at the time, because all this rehypothecation of money, blending of customer assets, all of this stuff was a mess. After Lehman Brothers, it was a mess. Even all of the clearing entities like the DTCC and Euroclear and all of this were a mess at the core. And there was systemic risk that us as individuals, without knowing it, could lose all of our money. And so Bitcoin made me realize that maybe custody could go on blockchain. And it also made me realize this digital gold idea. And I think I was probably the first person to write a paper approximating the kind of stock to flow idea. Now, not in the way Plan B does, he's a much smarter guy than I am, and my grasp of maths is not that, but conceptually, I wrote a paper, I don't know, maybe 2013, saying, well, with gold worth 1,200, Bitcoin should be worth $1 million, based around this kind of stock to flow idea. And that kind of blew up in Silicon Valley and across the macro community as people started going, okay, there's a macro framework we can apply to this. So I was involved in the space for a while. Then as part of that mission of trying to democratize financial intelligence, I realized that video was the answer. So I started Real Vision with 3 other co-founders to basically give everybody open access to the world's most famous investors, to be able to learn properly from the best people in their field, whether they're the best independent analysts, strategists, hedge fund managers, etc. So we rolled that out, and it's been, you know, a really big success. But as part of that journey, the first video we ever did, even the trailer we created for Real Vision, before we even started Real Vision, we'd never made a video. We had no idea what we were doing. But we put together this kind of disruptive video, which was very zeitgeisty of the time. And it was like riots and burning and CNBC clips that caught on fire and to the soundtrack of some sort of end of the world dubstep music. And it was all about truth in finance. And it was like basically the whole world is changing and it's falling apart. And in that was 2 things. One was the image of gold and the other was the Bitcoin B. And that was right at the beginning. The first piece of content we ever did mention Bitcoin, because I've been, you know, my job as a macro guy is to live in the future. So I try and see where the future is going and then take people on that journey with us. And Bitcoin and macro, I could see at some point in the future, we're going to collide. And so I got Real Vision people, firstly educating them about macro, because this matters, you know, what happens to the dollar, what central banks are doing, matters more than you picking your stocks. This is the big driver in this day and age, in a central bank driven world. And then I needed to offer a solution, and I knew Bitcoin was part of it. Eventually, those 2 things collided, and they collided with COVID. I knew they were going to collide in the next recession because I figured it was going to be a big one. Obviously, I didn't predict that this one was going to happen, but I did predict that we were going to have a recession from late last year. And now these 2 tribes have merged, and it's incredibly powerful because we've got now the smartest people in finance, people like Dan Moorhead, Dan Tapiero, John Burbank, Mark Yusko, Alan Howe, I mean, you name it, Jim Pallotta, people who traditionally came out of the hedge fund world and were leaders, saying, I'm going to leave a lot of that world. Some of them left it entirely, some of them partly, and said, I'm going to this new world because I think there is more alpha, more opportunity, and it's the future. Then we had the Silicon Valley guys with the same idea, but they came towards finance. They came the other way. We've created this great technology. We can engineer something that's different and better, and we can create a better future. Oh, by the way, this is finance. Oh shit, I need to learn about finance.
Right.
Then we had the kind of the libertarian philosophical guys who are involved in the whole thing, the anti-government, because the world we live in is a very polarized world, and it's creating a lot of unrest and uncertainty, and people are looking for answers. So Bitcoin became one of the answers. So, and now the investment and institutional community is paying attention as well. So everything has come together to this moment in time. And that's why we launched Real Vision Crypto, because it cannot be a more important time for everybody.
I love that. I love that story. And I totally agree. When I first was looking at Bitcoin, I approached it from a payments and fintech angle, because I knew how much complexity there was in the payments ecosystem. I was like, oh, this is a great solution to that. And then as you uncover and dig deeper, it's just so much more than that. What I'd love to know, you you mentioned that you started writing about it and sharing your thoughts with your subscribers really early. What was the response to that, and how has that evolved? Because, you're writing for a more traditional audience that is not, heads down in crypto every day, like, the rest of us are, or like you were. What was their response to you writing?
Well, interestingly, because I don't write isolated pieces, I have a macro framework of which I talk about and develop over years and even decades now.
Yeah.
So anybody who's a global macro investor subscriber kind of understands where I think this is all going. And many of the people also from the macro community understand that we are getting to the limits of central banks and their ability to drive economies growth and the debt cycle and the demographic cycle and these big things. So they kind of got it. And when we almost lost the European banking system after the GFC as well, they were kind of open to the idea of different futures. Now, people split down different paths. I was initially splitting down the path of, can I create the world's safest bank? We need something so people don't get killed in this environment. Others went straight down the gold path. And then a group of guys, Chad Cascarilla and Emil Woods, came to me and said, Bitcoin. And at that point, I went, I get it. Okay. And all this is all part of the same thing. So it came from that. And my writing about it, at first, the early adopters were straight into it because they're like, yeah, I get this. It's a massive, high probability, asymmetric bet. And in macro, you don't get many of these of this size. And, when I was writing about it, it was $50 or whatever when it started. When I first started investing, it was about $200. So the asymmetry was so large that it was worth the risk. Now, they couldn't do it in their portfolios, but they did it themselves. And then it started building upon it. So I never got a lot of pushback. There's some people say, I don't really understand it. Yeah. And I don't really know how to value it and stuff like that. So they kept away, but I didn't get pushback. On Real Vision originally, when we started, we got more pushback because there were a lot of traditionalists from gold who were very anti-central banks and said gold is the only answer and everything else. It's not, the argument would be in the early days, it's not backed by anything. Right. Gold is not backed by anything either. It's backed by trust. But because they're so anchored in the past, and there's nothing wrong with gold. It's always worked, it will work, but it doesn't have all the attributes. So it's been a journey and it still is a journey. And then the whole journey into the digital asset space and the journey of the Bitcoin maximalists now playing the same role as the gold people played. There can only be one. Yeah, there can only be one Bitcoin. Maybe it's the digital reserve asset of the world. Right. But we're talking about a whole space here. It's absolutely enormous what is happening. And yes, can it be built on the Bitcoin blockchain? Is it going to be? Some of it will, and some of it will go elsewhere, whether we like it or not. And also don't care about people's arguments about private blockchains not being distributed. They actually solve huge amounts of problems too. So, I'm massively interested in the whole space, but I'm now finding the same pushbacks that I got in early days in the digital asset space. People are like, don't get this. It sounds wrong. It's all a scam. I'm like, no, it's not. Early phase. We've got a lot to go. And, my guess is we have this conversation in 5 years' time. We'll be doing something else of which they think it's a scam and it's ridiculous. It's because the pace of change is bigger than humans are able to deal with easily.
Yeah, definitely. I want to touch upon something that you just brought up around inclusion of Bitcoin in a portfolio. So we just heard a best-selling personal finance author talk about the strategy about converting fiat, or what he referred to as fake money, into gold, silver, Bitcoin. As a macro investor, how do you balance investments in currency versus alternatives like gold, silver, Bitcoin?
For anybody to pretend currency doesn't matter is lying, or they're delusional, right? The foreign exchange markets trade 3 to 4 trillion a day. So anybody thinks that Bitcoin with its $200 billion market cap is meaningful in this equation is deluded. Can it be meaningful? Okay, that's a different discussion. So this talk about worthless fiat, it's not worthless. You know, I can buy something from you immediately in my fiat currency and it's universally acceptable by everybody. I can pay my taxes, I can get into the system. Everything works. It just doesn't work well enough. And it doesn't work for the future that we're trying to get to. And yes, it does devalue over time, but not rapidly. We're not in a hyperinflationary world. We're not in Venezuela. And I know everybody wants to go step one, step two, hyperinflation. It doesn't work that way. Certainly not with the world's reserve currency. It's just none of that is going to happen.
Yeah.
But the incremental change is happening.
Mm-hmm.
So when it comes to portfolios, it really depends on your own risk and what you want to get out of it. Not everybody is Michael Saylor that has gone so far down the rabbit hole. He can't explain that to the CFO of Disney. They're just going to think he's mad because he's talking about something different. But if you talk about the diversity, the industry needs to get on to talking about the diversification effects of owning Bitcoin in a treasury or investment portfolio. And it's not doing that. It's too busy trying to fight an ideological battle when it should just say, hey, listen, if you put 1% in your portfolio over the last 10 years, this is what it would have done. That simple discussion will change the world. But people are too busy going down the Michael Saylor route. And Michael's amazing. And he was, we had an amazing 2-hour interview with him on Real Vision. But that is not going to get the average person across the line. It is understanding that diversification. And then people will argue, yeah, but Bitcoin's correlated. It goes down when the dollar goes down. And that's only in the short term. It's a passing correlation based on retail trading, risk, and those things. But over time, that correlation is not significant.
Definitely. I want to shift gears a little bit, and I'd love for you to give us an overview of the state of the macro environment right now, and more specifically, yield outside of the crypto industry. And if you could talk a little bit about the different ways that investors have generated yield in the past, and how do you think opportunities have changed?
Well, all yield around the world is linked to one thing: the government bond markets. And basically, there are only two government bond markets that matter in the entire world. One is the US bond market, the other is the European bond market. Everything else is dwarfed. Even though Japan is big, it's not internationalized. So that, whether anybody likes it or not, is the cost of money, and that's driven by the central banks plus growth and inflation expectations. That's it. Every single other instrument is priced off that. So that's corporate credit, private sector lending, credit cards, everything. But they just have different levels of interest. So credit card payment interest is the highest in all time because the credit card companies, they're not necessarily being egregious, but the risk of default is very high right now because people don't have surety of jobs and income. In the corporate credit markets, well, the Federal Reserve stopped credit spreads widening out and interest widening out because they didn't want companies to get insolvent. So they backstopped the corporate credit market. The private sector lending market, well, that's more difficult. You can't actually access credit very easily. So credit across the world is hyper-connected to these two bond markets, and they just layer off that. That's called the risk-free rate. So the risk-free rate is that. Now, the question is are they risk-free? And what is that risk? And again, I'm not talking about the US government defaulting on its debt. That's nonsense. But deflating it away and increasing the issuance of bonds and making it that less valuable means over time you're earning both less interest because of the deflationary pressures of the world and how the central banks react to it, and the fact that the pension system has a bunch of aging people who all need a fixed income. You've driven yields down to impossibly low levels. Yeah. Now, they could stay there for decades like it has in Japan. Again, everybody's like, well, inflation's going to come. Depends what you think of as inflation. The whole value of fiat money is clearly depreciating against certain assets, and certain real assets are still increasing in value. Many other things aren't. Technology is massively deflationary. So yields are falling over time, but yields are what makes the financial world go round, which is why, and I presume you're going to come onto this, why what is going on in DeFi matters so much. Is without a yield curve, I cannot price future risk. And it's as simple as that. Nothing works without a yield curve.
So let's talk about that. This idea of a Bitcoin yield curve. Could you expand on that? Like how does the yield curve develop?
Okay, so a yield curve develops around the future expectation of the value of an asset and the risk of that. So a bond, because it's an income stream, is discounted by future inflation expectations and also GDP growth, because that generates inflation expectations. So it's basically inflation over time. Now, and that's what facilitates the lending of collateral and the use of collateral. And collateral is the thing that is the foundation stone of the entire financial system. It's what allows leverage. It's what allows borrowing money. All of that stuff is the collateral that you post. So if you think of, for the average person, you have to put cash down as a deposit on a house. That's just collateral. But in the actual financial world, US Treasury bonds and European government bonds are the collateral. So Bitcoin has all the attributes that I've been talking about for a while, you might have picked up, that I think it may be the world's best reserve asset, the best, most pristine collateral. The reason being is the US Treasury bond, I get virtually no interest for owning it or lending it out.
Right.
And they make more of it all the time. And that's the value of money going down. More Treasury bonds means those bonds over time are worth less money because the actual money that I get at the end of it is actually worth less. Bitcoin's the opposite, because there is a fixed, unchangeable supply, that it is deflationary by nature, so it holds its price appreciation almost better than any other asset that's ever been invented. And it's not variable. Gold is still variable supply. There is no variability. So you've got something utterly pristine as an asset, and that's what Michael Saylor's talking about, is in 50 years' time or 100 years' time, it is not going to be devalued by inflation.
Right.
So that makes it incredibly interesting as a collateral asset. Also, its blockchain and its distributed nature means that if the foundation stones of the financial system are built upon it, you still know who owns that Bitcoin. In the bond market, you don't. So when I spoke to the New York Fed, they told me that the average Treasury bond is reused 32 times. Now, this is the reason why, for example, Lehman was allowed to go bust, but AIG wasn't. The reason being is Lehman bonds weren't used as collateral because they weren't AAA. AIG was AAA and was used as collateral, so there was probably 20 or 30 times leverage on those bonds. So the Fed was like, no, that can't go bust because the house of cards falls down. So Bitcoin has this perfect attribute. The only problem is there's no yield curve in the future. I need to lend it to you to use. That doesn't work yet. But let's shrink down. Okay, what is a yield curve? A yield curve starts with the price of money. What is the price of overnight money, 1 month money, 3 month money, 6 months money? That is what DeFi is doing. We're not there yet. Some of the rates are ridiculously high because we haven't gone through a default cycle. So you don't actually know what the final outcome is. Some of these projects will fail. So you're seeing supernormal returns in theory, but the reality is it'll come closer down to somewhere where the financial markets are trading government bond yields. But I think there's a difference. I think that if I'm an owner of Bitcoin and I want to lend it to you to use, I'm going to get paid a higher rate of interest than US Treasuries. Not because it's a higher risk, which is how the markets work right now, but because it's pristine collateral. So if you think of it in the terms of, I can lend you a painting and you'll give me some collateral. Let's say it's worth $2,000. And I will expect a rate of interest because you want to use it for leverage. If I've got a Van Gogh, I can charge a lot more money. Because it's incredibly rare collateral.
Yeah.
It's incredibly rare collateral. And that's what Bitcoin is. We're not there yet. It's not going to happen overnight. But this start with DeFi and, hundreds of companies that are going to give it a shot. They're going to fail. But out of this, slowly will come the start of the money market. And Ethereum has some sort of inherent money market built into how it is because of the holding period for how it's created. So it's going to come. And when it comes, it'll move along the yield curve as more people find more uses for that collateral. Then we have a full financial market. Without that, we don't.
I love that. I love the analogy that you made with Van Gogh and Bitcoin being rare. I think that's a great way of framing it. So in the past, one thing that you've mentioned that presents a challenge to Bitcoin's use as collateral is that today it's volatile. Part of me believes that the volatility in Bitcoin is a feature, not a bug. It's a function of Bitcoin being almost perfectly inelastic. Like you said, even gold is not as inelastic as Bitcoin. I've also seen a few references to the monetary asset trilemma, which says that policymakers can only satisfy 2 of 3 objectives. And Bitcoin chooses a fixed supply and free flow of capital at the expense of a stable exchange rate. On the other hand, we're seeing volatility declining as larger players enter and as the market structure develops. So what are your thoughts on this debate? And do you think that Bitcoin's volatility precludes it from being used as a store of value asset or pristine collateral?
Bitcoin's incredible because it embeds a number of different things. It is a call option on the future, that I've used that expression many times, on a future financial system. It has value now because almost everybody in the Bitcoin world treats it as a store of value, but they have to, with it, get the volatility. So in market terms, we all still think the risk-adjusted return is high enough to have the volatility. So I can take a 70% downside if I think the upside is 100-fold or 25-fold. So that is, its risk-adjusted returns are fine for risk-seeking capital. So it's like the early stage of VC. You'll accept the volatility because you understand that, you know, and small stage firms nearly go to the wall several times, and eventually it becomes more stable, and eventually their volatility reduces. The next phase of Bitcoin will see volatility diminish from 60%. You know, it used to be 100%. It's now 60%. It's going to normalize towards equity markets and commodity markets. And they fluctuate between, in a normal world without, you know, it being a crisis, you know, business cycle,
Right.
between 20 and 40%. So if Bitcoin gets down to that, that's going to take institutional activity, more market making activity. It just needs more participants, because the problem is all of us just buy and hold it. So incremental buyers and sellers move the price around a lot because of the stock to flow issue on a day-to-day basis, because we're all holding the bloody stuff. So somebody who sells $100 million worth moves the price a lot more than it would do in an equity market where people are more actively trading. So that has to change, and it will change over time. And it will change as the price goes up, and it will change as the market cap goes up. It's only a $200 billion asset. It's tiny. It's not even an asset class yet in the big boys world of assets. You know, it's just meaningless. So that's great. We understand that. It's meaningless means right now, not what its future thing is. So right now, we've still got the asymmetric side of this thing. Once the asymmetry starts petering out, we will go to the different phase. That's when, then you can start asking questions in, call it 15 years time. Can Bitcoin be money in terms of a medium of exchange? It cannot be now. Now, as you said, some countries have higher volatility currencies. So the Australians have a higher volatility currency than the Europeans. That's okay too. And Aussie dollars are still used as collateral. So volatility doesn't preempt it, but 60% volatility does.
Right.
And so it's not collateral right now because I can't borrow much money against my Bitcoin because the volatility is too high. In due course, it'll come. So it's maturity. It's like having a kid and saying, well, why can't it speak yet? Why is it not, can't it make its own dinner? No, it's 1 year old. You know, it's just, we got to realize that it's a journey and we have to go there, and it's going to take time.
Yeah, time and patience. And
but but the point being is you get rewarded for that.
Right.
So, you know, one of the things that, for example, I was actively involved in the past was Iranian equities. What's that got to do with this? Because most people couldn't go to the effort of buying them. The US had banned them. Europeans weren't banned from it. But if you do, you got supernormal returns because it was a little bit more difficult. If there was an Iranian ETF that trades all day, most of the returns are gone.
Yeah.
It has to be difficult. It has to require pain. It has to require risk-seeking capital. And that's what we're getting in Bitcoin. And what's amazing about Bitcoin, it's been driven by individuals and not hedge funds or institutions, because hedge funds and institutions couldn't take the type of risk that Bitcoin required, but individuals did. And it's astonishing.
Totally agree. It's incredible to see the distinction between Bitcoin and the impact of it being a retail-driven market versus other asset classes. So, you know, one thing that you mentioned earlier is rehypothecation. And what I'd love for you to do is explain a little bit more how it works in traditional markets. And then, you know, as more Bitcoin flows to central service providers and as more institutions enter the space, will Bitcoin be able to be rehypothecated, and to what extent will service providers allow that?
So rehypothecation is basically also known as the daisy chaining of collateral. So I give you my treasury bonds because I want to borrow money off you. You are big bank A. Big bank A wants to borrow money because it needs more capital needs. So it then lends those treasury bonds out to big bank B and big bank C. And 32 times it can be reused. And sometimes it can be up to 100 times. So we're basically using the same piece of collateral and paying each other a little bit of extra interest to do that. The problem is if something happens, like heaven forbid, what almost happened in 2012, government bonds almost went bankrupt, but it almost went into default. Well, then everything goes, because your leverage, my leverage, the next bank's leverage, the next bank, they've all gone. So that's why it's dangerous. And when you got to a situation like Lehman Brothers, you don't know whose assets are what. So assets kind of are fake. And so rehypothecation works to allow leverage. Over rehypothecation creates systemic risk. And then in the end, who's the original owner of the asset? That's the complicated way. What's super interesting about blockchain, and particularly smart contracts on top of that, is all of this can be recorded. So there is no issue with subordination, who gets what and how it works. Rehypothecation has to be part of what Bitcoin builds as well, because that is how a financial system works. I mean, credit is, too much credit is bad. And I like Bitcoin as collateral asset because guess what? If we're in a business cycle, which is usually where there's a shortage of credit available, like we've got now, well, the cost of credit should go up, which is what's happening. Now, the cost of collateral to secure that credit should go up accordingly. Right now, it doesn't, because the central banks lower rates. So the price of collateral doesn't go up, so we don't get the proper business cycle. Bitcoin, by its nature, the price would go up. If we were all fighting for Bitcoin so we could borrow some more money to pay our bills, the price of Bitcoin's going up. It becomes super collateral, which is, again, very different to where the world is now. So that within rehypothecation, you can allow the rehypothecation, which means we can all build leverage and credit markets and depth and maturity. But in the end, it is self-policing in terms of leverage, because the price of the collateral goes up, that I can't afford it. So I'm like, okay, I'm out. So we can't build leverage upon leverage, because right now the collateral price doesn't go up, it goes down. So it just gets cheaper and cheaper as the central banks jam more collateral, lower rates, issue more bonds, give people more lines of credit. And that's part of the failings of the entire system. So yeah, all of that has to come with a yield curve. Rehypothecation is part of it. And it sounds like it's evil, but in the Bitcoin world, it should be Austrian enough that you can have creative destruction without total destruction.
Definitely. I appreciate you, presenting that nuanced argument, because I think it's often presented as very black and white, and people hear rehypothecation and just, shrug away. So thank you for that. Another trend this year has been prime brokerage. That's been, one of the buzzwords of 2020. Could you talk about the state of prime brokerage in crypto markets? Is there a true prime broker that exists today? And what is the ability of this function to facilitate Bitcoin borrowing and lending markets?
Yeah, so prime broking was really built to facilitate the hedge fund industry to get access to leverage, because their business model is leverage investments, both long and short. So prime broking is essentially that. Mm-hmm. And again, it's basically a collateral business. You're positioned to use as collateral. They kind of net them off, look at overall risk, and will lend you money against it. So if your entire position was US Treasuries, you'd be able to get a lot of leverage. If you've got a bunch of stuff like wheat and corn futures, blah, 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 you can borrow less because they're volatile. So hedge funds, who are very large players in all of this space, can't really trade Bitcoin very easily. It's like RIAs can't invest easily because there's no ETF. For hedge funds, you really need prime broking. And the regulatory change that came to say that US banks were allowed to custody Bitcoin is code word for go ahead, build prime broking around it. Mm-hmm. So once you build prime broking, all the issues of hedge funds that people like Paul Tudor Jones have had to go through, or people have done it in their own personal accounts, or try to figure ways by using, Grayscale's products, all goes away.
Yeah.
Because they can buy Bitcoin, they can use other assets to buy Bitcoin that goes in that portfolio. They look at the portfolio overall, or they buy Bitcoin, they can relend it out, and they can buy equities, all of the things that prime broking offers. It's going to make a huge difference. It'll massively increase the liquidity of the market. Mm-hmm. What's super interesting is it will be a one-way bet for a while, which is everybody wants to acquire it. So you get to front run. You get to front run the ETF, the prime brokers, the institutions, the pensions, the family endowments, the family offices. It's the biggest legal front running opportunity of our lifetimes. It's fantastic. And then over time, as hedge funds, think that the excess return has been captured in their time horizon, they'll be shorting. And what we'll do is we'll start dampening down the volatility as we get a lot more daily activity in considerable size.
Definitely. I think, one trend that we're seeing even before people started rolling out prime broker like solutions was the flattening of the, landscape between Bitcoin and other assets. So it's increasingly become easier to express an interest for investors in traditional markets to express an interest in Bitcoin. So this will definitely kind of make that easier.
Yeah, I keep explaining to people is, look, things are moving fast. Everybody's working really hard on this. In a year's time, there's almost going to be no impediment for an individual, an investment advisor, a pension fund, or a hedge fund to own Bitcoin, because all of those vehicles are coming. Somebody will get the ETF across the line soon. The prime broking will be starting, and the trustees will start agreeing stuff. That's all within the next 12 months. Mm-hmm. So, if you go back and look at Plan B's stock to flow model, you can see why it can work, because you're basically going to front run all of these people, because they're all about to get access. And access has been the problem, and that's why we've been paid supernormal returns. So, all of us who are accumulating Bitcoin over this period, we will get the benefits of being those early adopters, because everybody else has to come in later.
So in certain asset classes, derivatives markets are orders of magnitude bigger than spot markets. I actually just saw a tweet before our chat today that said that CME is doing more volume than Binance, and Bakkt is doing more volume than Coinbase today, specifically. As Bitcoin grows and matures, do you expect this trend to continue? And then what are some of the risks involved with an asset that has a larger derivatives than spot market?
Unfortunately, humans are humans, and they will make the same mistakes every time. They will over-lever everything they possibly can because they want to chase the dream. It's just humans. And the credit cycle has been in existence as long as humans have had money. And the derivative markets is part of that. And it's a shame. It's a shame that rehypothecation, it's a shame that derivatives, and it's a shame that they're going to break down component parts of this stuff into products that nobody understands, but it's going to happen. Mm-hmm. It's going to happen. And yes, derivatives actually lower the volatility of most asset classes until there are large derivative positions one way or the other, and then you massively increase it.
Yeah.
As I've always said, suppressed volatility tends to lead to hyper volatility in the end. Mm-hmm. So look, unfortunately, because people want to make supernormal returns and Bitcoin's ridiculous asymmetry is not enough, they want options on that ridiculous asymmetry. And then they want to leverage it more, and it just is. And we just have to get over it. What we need to hope is that the fact that Bitcoin is not influenced by the cost of money and the current existing financial system, that as a collateral, when it becomes scarce, it goes up in value, it self-limits the amount of leverage that goes on. And that would be a really good thing.
Got it. I was listening to one of your podcasts, I forget which one, and in it you mentioned that, we could do more work as a community to show Bitcoin as a portfolio diversifier. Could you explain what is missing and how we as a community can kind of help bridge that gap?
People are too busy shouting in Bitcoin, you don't understand, this is the future, without trying to listen to the other side. What are their needs? Their needs are not you shouting, the financial system's going to end, we're going to hyperinflate. That is not what you need if you want adoption. What you need is to show somebody how it helps them. Mm-hmm. And the asymmetry is part of it. That's okay. But really, what moves it for a pension plan? It's not the asymmetry, because they're not really in the business of trying to make excess returns. They're trying to make stable returns over time to meet your pension obligations.
Right.
If you can show that Bitcoin in a portfolio creates diversification effects, i.e. portfolio effects, mm-hmm. what it will do is dampen the overall volatility of the portfolio and probably increase the returns.
Right.
That one simple message is all anybody needs to get across. And I've lived this. Back in 1998, Goldman Sachs, when I was working there, started the GSCI commodity index. Mm-hmm. And they had one thing. They had a big commodity trading group. Goldman had J. Aron, which is a commodity trading firm. But they wanted to institutionalize it. And so the simple thing is, we're going to create an index for you. Let's call that the Bitcoin ETF. Mm-hmm. And we are going to put that in your portfolio. But we don't like commodities. They're super volatile, blah, blah, blah. And we don't understand. And they said, that's exactly right. But look at this magic. If I put this in your portfolio, it actually diversifies your other returns and doesn't look like other things. And guess what? Over time, we're about to be in a secular cycle for commodities. It will be a portfolio diversifier. And everybody went, I get it. And they all bought it. And hundreds of billions of dollars flowed into the commodity space.
Yeah.
It's exactly the same process. If you do not speak other people's language, they will not listen. And that's why I know people hate it, but the people who are going to have the biggest success with this whole industry are going to be the investment banks selling it to institutions, because institutions don't trust everybody else. But if the moment that an investment bank writes a paper saying this is the portfolio diversification and here's a bunch of maths to prove it to you, and this is how it works in the efficient portfolio theory, blah, 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 one by one, they'll all change.
Definitely. Yeah, I've seen a few good analyses showing the impact of Bitcoin in a portfolio. And what's magical is the impact of rebalancing, at least historically, and showing that even if you bought Bitcoin at the peak, if you rebalance consistently, I think it was like quarterly or monthly, your risk-adjusted returns are still slightly better in a portfolio that includes Bitcoin than a portfolio without Bitcoin. So I completely agree. We need more analyses like that, and we need to share it with the institutional investors that are on the sidelines.
Because the ideological debate that comes up too much, that swamps Twitter and everything else, scares people off. It does not attract them.
Agreed. I think you have a hard stop in a couple minutes, but I wanted to ask you one last question. We've heard multiple announcements from large institutions getting involved, including Paul Tudor Jones, MicroStrategy, RenTech, and you talk to and advise institutional investors regularly. Are these announcements having an effect on institutional interest, and what narratives are resonating with them?
The reality is everybody I know owns it themselves. So most of the battle's been won. Mm-hmm. It's actually been won. It's the prime broking, the access for their larger businesses that's harder. So, I mean, of my community, and again, it's a biased community because people have been reading my research for a long time or know of me, most of them own it. But it's not in their funds yet. So again, as I keep saying, this is a front-running opportunity because they're all going to put it in their funds. The more it goes up, the more people will buy it because it becomes a larger asset class. And therefore, they can justify easier to their trustees or their directors or whoever it may be. So it's coming, yes, the more and more super traditionalists, yeah, that's going to take time, you know, to try and get the General Electric pension plan into, it's going to take forever, or the fireman's pension plan. There'll be a few trailblazers, but that takes a long time. And that takes the pension consulting firms to show the diversification and how to store it. And, you know, the work that Fidelity's doing, you know, all of this stuff is crazy important to get there, but it takes time.
Definitely. Well, Raoul, every time I hear your perspective, I'm even more bullish on Bitcoin. So thank you so much for taking the time to chat today, and I will pass it back to Luke.
Perfect. Yeah, I'm irresponsibly long, as I say.
I love it. No, I love it. Awesome presentation. And you know, I know that we're running out of time, but I do have to pull one question out of the chat, which is, Raoul, explain your background a little bit. What's going on with this? I think you win of best backgrounds of the day.
That's my beach house in Little Cayman, a small island.
Dog walking around too.
I got two dogs. I got two dogs, and yeah, so this is my beach house in Little Cayman. I live in Grand Cayman, and I came over for COVID, and yeah, I'm a very lucky boy.
There we go. All right, I love it. Thank you both for joining us today for your first Benzinga Bootcamp.
Great to be here. Thanks, guys. Take care.
Thanks so much.
Right.
Bye.
Care. All right, all of you boot campers, I want to remind you that today's event is brought to us by BlockFi. I'm going to go ahead and drop the link once again into the chat. We've got a special offer that BlockFi is extending to everybody who's here today, which is that you get $50 worth of Bitcoin just for joining. You know, we got to hear from Zach a little bit earlier about the BlockFi products. It includes a high interest account, USD loans, no fee trading. I personally set up my BlockFi account for the first time today during one of our earlier presentations. It was maybe a 5-minute process, very easy to do. No reason not to get started. After all this conversation, all this crypto talk today, I think I can say that I am myself fully converted and going to be looking to make some moves within the upcoming couple days.